A very good afternoon, good morning. Welcome to HYCM's live workshop with myself, Giles Coughlin. Really looking forward to getting us ready for the coming week, as well as looking backwards to see what happened last week with the ECB rate decision and the Bank of England rate decision. Hope everybody is doing well. Just going to start the session by giving ourselves a little perspective. Markets are pretty quiet today, really just waiting for Christine Lagarde's speech coming up later in the session. So that will be the focus, particularly for the euro. So I just want to give ourselves a broad understanding of where we're at with markets. I will be covering a lot of the material. I'll be looking at how to trade the US CPI print. That will be a focus for Wednesday. I'll briefly touch on that today. And we will be looking at some of the key markets that are in focus at the moment with the Russia crisis, the Australian dollar offering a good value in my view, US oil, what's the medium-term outlook, what's going on with the dollar, as well as looking at the commodity market of copper, and looking at China's A50 index, which again is offering really good value at a support level. So I will be going through that, as well as the New Zealand dollar, expecting Governor Orr speaking later on overnight. So expecting some New Zealand dollar gains at some point heading into the 23rd of February RBNZ meeting. But there's some risks with that. The New Zealand dollar has been so weak. So make sure we pick our levels very carefully if we are looking at New Zealand dollar longs, given the recent dynamic, which has been very negative for the New Zealand dollar, despite the pretty good fundamentals. So without further ado, we will get stuck into the webinar and just looking at the week ahead. First thing to say is very quiet week, okay? Now, we've got CPI print coming on Thursday, and we've got a couple of central bank speakers, Governor Macklem, RBA Governor, and Governor Bailey. So a lot to digest in terms of central bankers. Now, last week, I think there's so much to cover. The first thing to do is let's just get a bit of perspective. So in order to get a bit of perspective, let's just look at equity markets. Now, we'll also cover the China's A50. Now, the big picture has been as follows. Equity markets have been selling off since the start of the year, particularly in the US, over inflationary fears that the Fed is going to have to hike interest rates aggressively just as growth is slowing and inflation is slowing. That's the fear. As a consequence, equity markets have been selling off. Now, there remains a question mark here. And the question is, remember, just because interest rates rise, it doesn't automatically mean that equity markets fall. Now, you could be forgiven with the narrative that we've been having going on. You might think, okay, if interest rates falls, then equity markets have to fall. No, not necessarily. Equity markets can rise at the same time that interest rates are rising, as long as growth is not rapidly slowing, okay? So what investors have been fearing is that interest rates are hiking at the wrong time, just like the Fed did in 2018. When you see in 2018 at the fourth quarter, you see that sharp correction that took place. You see, fourth quarter 2018, we saw the NASDAQ fall 25%, right? Because the Fed were hiking just as growth was slowing. So fast forward to today, that is the similar dynamic that markets are fearing, that, oh, hang on, the Fed is hiking just as growth is slowing. Now, we've seen NASDAQ fall like 18%. Now, a couple of things to say that are important here. So first of all, just take a look at one of my tweets that I've just tweeted out. It is really relevant for this. And, you know, a really good tell. Right. Look at these historical corrections in the S&P 500, right? When the S&P 500 corrects like over sort of 25%, that almost always results in a recession. So put yourself in the Fed's shoes. Gosh, you're thinking if stock market's correct, so plus 25%, it means we're heading for a recession. So it's when equity markets correct this amount that the Fed gets worried, okay, that they'll start to shift their perspective. So bear that in mind. The only time it didn't was 1987, when the Fed, when there wasn't a recession, despite a large correction in the S&P 500. Right, now you're getting zoned in with the issue. So that means at the moment, 18% correction in the Nasdaq's okay from the Fed's perspective. S&P 500, we're looking at a, sorry about that. We're looking at a 12% correction. Okay, so just to put this in perspective, the area where the Fed are going to get begin to get concerned is going to be like maybe down here, right? 23, 24. So this kind of region here. We can just put this, right? So we can see it's that area that the Fed are going to get concerned. So there's quite a lot of area for the S&P 500 to still correct before the Fed get really worried. Look, that's the big picture. So is the Fed making a policy mistake? We've had earnings, that's now out the way. Mixed bag of earnings. Some earnings was a bit of a disappointment. Netflix was a bit of a disappointment. Facebook was a disappointment. But some, Tesla again, a little bit of disappointment. But then some earnings are really good. Amazon did really well. So it was a mixed picture in earnings. We were looking at earnings, remember, to see, is the US slowing? If it was just like a disaster across the board, then this equity selling would have carried on. But it wasn't. It was mixed. So what does that mean for us? Well, it means caution. It means, first of all, that growth and inflation remain key metrics going forward. And we also have to be cautious about this area, whether it is a bottom or whether it isn't a bottom. At the moment, what we can say is that markets are cautious. If growth and inflation start showing evidence of slowing down, then look for further falls. We've seen that the Fed's going to get, when I say the reason we're looking at what's the significance of that is because that's the level where the Fed will change their policy, right? That's the region, if you go down 20%, 25%, the Fed will say, oh, actually, we're going to stop this interest rate hiking lark. Now, obviously, they're hiking interest rates mainly out of fear of inflation, with inflation surging in the US, much more than it is in Europe, and highly politicized. So big issue with inflation. And we've got central banks around the world tightening. Federal Reserve expected to hike, 4, 5, 6 times this year. Bank of Canada, 6 times this year. ECB Stir Futures now looking at 2 25 basis points hike this year after the last ECB rate meeting. Bank of England, 4 hikes this year, UC. So all that tightening is making stock investors nervous, and obviously higher interest rates, higher debt repayments, lower profitability hits companies' earnings. Now, the reason the A50 offers good value is as follows. I'll show you how to enter and what the trade is. Right, look at the A50. This is China's 50 index. Fell like nearly 30% last year. Now, the People's Bank of China is cutting interest rates, expected to cut interest rates again. So unlike the rest of the Western world, China is starting to stimulate the economy again. So this means this sort of bottoming region, you see this like price bang, 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 we're right in support. You could look to enter at market, stocks just underneath 14,500, looking for a play higher. Now this is a Harami inside bar pattern. And when you have a break of the Harami inside bar pattern, you can just enter on the break at 1506, stops just below the low, below 14,500, and looking for a move back up to 1400, 16,500. Lovely entry, nice technicals, nice fundamentals. And if you're wrong, you just take the hit. The other place to enter is down at the 1400, stops just below the 1330 region. So from a more medium-term perspective, obviously check your rollover fees, etc., but from a more medium-term perspective, this does offer good value. And the monetary policy condition is different in China than it is in the rest of the world. So that gives us some of the big picture that's going on. Now, let's just take a look at the majors and have a quick look. Okay, first of all, bond market. What do you see? Bond yields are surging. Is that a surprise? No. Bond yields are surging because investors are expecting central banks around the world to start lifting interest rates. Bond traders are very sensitive to interest rate hikes. Bond traders tend to be steadier. They look out under 6 months, 12 months time frame. So they're looking ahead and they're seeing interest rate hikes are coming. Bonds are selling off. That's sending yields higher. Look across the board. Now, in terms of the majors, let's just get our head around what's going on. Dollar has been surging for some time and is now pulling back just as a natural pullback, okay? The euro has gained. That strength in the euro just weakens the dollar. Remember, the dollar is called the anti-euro index. So it does the opposite to what the dollar does. And if you just overlay the euro-US dollar pair onto, do you see how falling euro-US dollar, rising dollar index? Rising euro-US dollar, falling dollar index. And if we just inverted the scale, you see how close? So you could trade the euro-US dollar and the dollar index interchangeably, and that's because the dollar index has like nearly 6% weighting of the euro. Very, very heavy weighting, and that's why you get this very strong correlation. Now, at the moment, the dollar is just showing weakness with that euro strength, but then we had the very good jobs report on Friday. Okay, so we had the ECB on Thursday, made quite a dovish tilt. You see the euro strengthening against the dollar? If we just take a look at the euro-US dollar pair, it'll be simpler. See the euro strengthening against the dollar on the Thursday? That is because the ECB had a much more hawkish shift. Now, I'll tell you what happened, and I think this should be on my blog now. I think, let me just give me a second. I think I've got the check. I think I just can. My team just put it out on. Yeah, here it is. Copy link. Right. So this is actually here. The only way is up for rate. So what the ECB had done. So this is on my blog, HYCM blog. Make sure you check it out. I update this. I've got a Bank of England report coming out as well, like tomorrow. So I'll just put this in the chat box. If you haven't or not following my blog, just make sure you're following it there. You also follow me at Twitter at Giles Cochran CCA. Right. So here we go. Now, basically, what the Christine Lagarde did is she revealed a couple of things. There's unanimous concern from the Governing Council surrounding rising inflation. There was a huge surge in inflation that came out of the Eurozone. Now, have a look here. I'll show you it here. Do you see? The ECB target is 2%. Look at the HYCP. It served over 5%. This is the inflationary print that came out the day before the ECB rate meeting. And yes, when you take out energy, remember a lot of this is natural gas prices, oil prices, food prices. If you take all that out, core inflation is still just above target, right? So the core is okay, but the headlines got them nervous. The only way that central banks control inflation is by hiking interest rates. So that's what they've had to do. And what they've said is essentially they're moving closer towards hiking interest rates. That's what all that fuss was last week in the euro, because Christine Lagarde, she dodged the question about whether a 2022 rate hike would be appropriate. The fact she didn't deny it was important, because previously she'd sort of denied it or pushed back or said we definitely won't do it. But she said nothing. And later on, there's a sources report, and the sources report said that the ECB agreed it was sensible not to exclude a 2022 rate hike. So they're worried, right? Now, let me explain to you how it works with an ECB meeting. You've got the rate statement, then you've got the press conference, then you've got what's called sources piece. So that means the ECB has 3 different opportunities to communicate to the market. One at the rate statement, then 45 minutes later you have the press conference, And then after the press conference, throughout the rest of the afternoon, you have what's called sources meeting. Okay, so that's whenever you're looking at ECB meeting, thinking, okay, I've got the rate statement, I've got the press conference, and I've got sources. 3 opportunities. So the ECB have made it clear they're worried, right? So that means euro pound, that looks like key support now in the euro pound for the near term, as long as the ECB remain on that more sort of hawkish bias. So I was trading the euro pound out of the event, and there are 2 opportunities to still get back into the euro pound. So first of all, say that that is, even at market, that's quite hawkish. With a hidden bullish divergence there on the 1 hour chart, but I wouldn't be looking at entering that. Any retrace with that Nasdaq 8420 or that 8380 region is suitable for going long. So either in that S1 and that S2 pivot point is suitable for going long today. Okay, now stops just the other side of that 200 exponential moving average, maybe just underneath 8350 or the other side of 8280. Right, that would be the places to put it as your stops. Now, a couple of things. Christine Lagarde is speaking tonight. Now, if you want help understanding what she's saying, what the significance is, look at the bond market. So, you see the way that 10-year yields surged higher, okay? With 10-year yields surging higher, if Christine Lagarde pushes back and starts saying, oh, maybe we probably won't hike rates, and starts giving more dovish commentary, that will stink the euro. But look at the bond market. If the bond market starts finding bids and yields start dropping, then yeah, that makes sense. Then expect euro weakness again. But if the bond market stays firm, it means the bond market isn't believing Christine Lagarde and thinks she's going to have to respond to rising inflation. So when she's speaking, keep your eye on the bond market. If you haven't seen bonds, just look at the 10-year yield and the 2-year yields. In TradingView, it's just DE10Y or DE02Y. Okay, rising yields means greater chance of interest rate hikes. Falling yields means falling chance of interest rate hikes. The only time yields surge apart from that is in times of stress, but that's for another topic. Okay, generally speaking, rising yields, rising chance of interest rates. That's the general rule of thumb. Okay, so that's that's where we're at with it. Bank of England also met last week, and there was a more hawkish tilt. Now, the ECB's outlook has moved higher at a greater pace than the Bank of England. The Bank of England, this wasn't a surprise to see a rate hike. It wasn't a surprise to see 4 members voting for a 50 basis point rate hike. Saunders, Ramsden, a couple of others, Haskell, voted for a 50 basis point rate hike. That was a surprise. Okay, if you haven't read central bank reports, do have a read of them. They're very helpful. They'll help you to also know what's going on around the world. See, this is the Bank of England referring to China, referring to US GDP, referring to Euro area GDP, referring to Euro annual HYCP inflation has increased to 5.1% in January. Remember I showed you that? That's this. So that's the ECB, BOE talking about ECB inflationary pressures. So very helpful to read the central bank's minutes. So the Bank of England also is taking a more kind of hawkish stance. So I would say like currencies like the pound Swiss franc makes sense. So pound Swiss franc longs from any kind of area where it's sensible to manage risk. Similarly, like pound yen longs as well. So if you just look at the pound yen, as long as yields keep moving higher, you expect like you could enter at market, stops just below S2, makes sense. That would be nice from a medium term perspective. 154 stops just the other side, 152. That makes sense from a medium term perspective. The only thing to watch out with the yen is this relationship here. Like, don't forget that the yen and 10-year yields have a very, very strong relationship. Let me just show you. I will get there in the end. Here it is. Right. If you look at And this is like part of my role as I work for financial sources and analysts. These are the charts that I'm using. Now, you see the red line is the 10-year yields. So when 10-year yields rise, that weakens the yen. Rising 10-year yields, weak yen. Rising 10-year yields, right, weak yen. Falling 10-year yields, stronger yen. Falling yields, stronger yen. Falling yields, stronger yen. Falling yields, stronger yen. You got it? So if 10-year yields keep rising higher, then the yen should stay weak. But remember, what many people are expecting is growth and inflation to slow down. So US 10-year yields are expected to drop medium term. So that can strengthen the yen, which would maybe like negate a pound yen long. So maybe like pound Swiss franc might be better. That's what I'm saying. Right. A lot just to get our head around, but I hope that's helpful. I hope you begin to see, hope you begin to understand how these factors work in. So what we got, Governor Orr speaking, right. New Zealand dollar has been very weak recently. Surprisingly weak when you consider this, like look at this. The RBNZ at their last interest rate meeting, they're expecting to like, this is from a weekly perspective, they're expecting to hike to 2.6% by the end of 2023. They're at 0.75%. So does this look like a central bank that is on the edge of a rate hiking cycle? No, it doesn't. Look at that weakness in the New Zealand dollar. And if you look at this in a candlestick chart, I saw, look, you know, last week was the first week. So we had 1, 2, 3, 4, 5 weeks of selling. Last week was the first week we saw some strength in the New Zealand dollar. That's odd. Now, one of the weaknesses with macro trading is that, you know, markets can remain irrational. So that means we have to always look at planning our trade carefully. So Governor Orr was speaking. So if he's bullish, we'd expect that to continue to support the New Zealand dollar. New Zealand dollar yen upside continues to make sense, right? We are at a key support level. Stops can be placed just below 74.50. 74.20, looking for a move higher, back up towards that 82 region. The risk reward makes sense, but just put your stops there in case the market remains irrational. Similarly with the New Zealand dollar CAD, but a little bit of upside there. Also with New Zealand dollar Swiss franc, we expect upside there in the New Zealand dollar Swiss franc over the medium term. You know, but again, you can see pretty resilient, but I think buying at market, the stops just underneath 0.5942 makes sense, okay, for more upside in the New Zealand dollar Swiss franc. So just watch out what Governor Orr says. If Governor Orr is like way more hawkish, then expect, you know, gun to my head, I'd expect him to be hawkish and I expect him to put bids into the New Zealand dollar. So just watch that coming out tonight. Governor Macklem speaking, last jobs data print was a big disappointment for Canada. But oil supports the CAD. So remember this, if you ever, you know, the US dollar CAD pair has like a 96% negative correlation with oil. And this is easy when you see it. Okay, there's dollar CAD. Let's just have a look at oil, put oil over the top. Oil's in green. Let's invert oil and you see the connection, right? The connection is very simple. And I'm going to uninvert the scale. Oil's in green. When oil rises, dollar CAD falls. When oil falls, dollar CAD rises. When oil rises, dollar CAD falls. When oil, let's just check. Got it. Yeah, that's right. So falling oil, rising US dollar CAD. Rising oil, falling US dollar CAD. So at the moment, with oil rising, okay, we'd expect to see dollar CAD falling. If oil suddenly turns over and suddenly sells off sharply, expect dollar CAD upside significantly. So the trade is on any negatives for oil. If oil just capitulates heavily lower, look for dollar CAD upside. Really good opportunity. That is a nice area to potentially go long. The only reason why I wouldn't go long there is because oil has just been so strong. Okay. we've had a series of low inventory reports. There's worries that OPEC couldn't increase demand even if they wanted to. So there's also strong seasonals for oil. Check out my blog, got loads of seasonals, copper, for oil, etc., etc. And make sure you're all over that blog there. But that's what's going on, okay? So Governor Macklem, look for his interpretation of the last jobs data. CPI, come back on Wednesday, we'll dig into the detail, and so we'll get ready to smash that. Bank of England Governor Bailey, remember, I'll have a report up on my blog tomorrow about the Bank of England Governor Bailey, so check that out. Governor Lowe, let's see what Governor Lowe says. He turned a little bit more hawkish after the rate statement. Let's see if he's maintaining that upside. I think there's a good case for Australian dollar upside over the medium term. China, they're cutting interest rates. Remember, what's good for China is good for the Australian dollar. Would make sense to see some Australian dollar gains over the medium term. In fact, let's just look at this. Yeah, just look at this relationship here. So this is a basket of the Australian dollar. So here, this is China's 50. Do you see how when China's 50, the dark green, this light green here, when China's index rises, Australian dollar rises. When China's index falls, the Australian dollar falls, okay? So with China's 50 index expected to recover now, People's Bank of China looking to cut interest rates, we expect the Australian dollar to gain as well. You see the connection? You know, rising China's 50 index, rising Australian dollar. You know, falling 50 index, falling Australian dollar. Now, it's not a perfect correlation, but you see it's pretty good. It's been pretty good since March 2020. So with China's index expected to turn around, with the RBA, check out my blog, they've now ended their asset purchase program. What have they got to do now? Only hike interest rates, right? So you'd expect to see some Australian dollar strength. Whether we will or not remains to be seen, but that relationship should remain pretty decent and is certainly worth looking at going forward. Folks, I hope that's been helpful. I hope that's got you up to speed. Don't forget to come back on Wednesday, right, 12:30, 1:30. I will go through the CPI data print, what that means for the dollar, the potential opportunities in the euro-US dollar as well. So that will be, you know, good, and that'll get us really up to speed. Folks, it's been a pleasure as always. Hope everybody is doing well, and I look forward to coming back on Wednesday. Make sure you're following my blog, just keeping up to pace with the narratives. Thank you all very much for attending. Good to see some familiar, friendly faces and names here. Richard, Warren, great to see you. Gary, Nahar, Maurice, Stefan, Danny, Naya, lovely. Richard, super. Take care, everyone. Danny, first time, good to have you. Great, thank you, Richard. Lovely to be there. Danny, very welcome, first time. Don't forget to ask questions. You're welcome to anytime, anywhere I can help. Always happy to. Take care and see you folks Wednesday. Thanks, everyone now. Goodbye.